Hi, welcome to Know It Olly ELI5's capital gains. So, what are capital gains? Capital gains are the profits you make in a trade. So, you take the sell price, say you sold something for $5, you remove the buy price, you paid $2 for it, your gains are the $3 increase in between. The great thing about capital gains is that they only occur when you sell. If you buy something for $1 and over the next year it goes to $1,000, you might have $999 in unrealized capital gains, but you only actually have to pay tax or do anything about those capital gains once you've sold. Because once you sell, you realize your gains. Up until you sold, the price could have gone back down to $1 and you would have had no gains. But because you sold at a gain, you now have capital gains, and typically you've got to pay some taxes on that. The best way to avoid as much tax, at least on this, is by being in a trade or an investment for longer than 1 year. Once you hit that 1 year threshold, the amount of tax you pay on those gains is drastically reduced. Prior to that 1 year, most countries see it as income, yearly income earned. However, if you've been in that investment for longer than a year, it becomes an investment, and that completely changes the entire tax system that it gets put through. So minimize taxes by hodling for a long time. Pretty much anything can be assessed. Well, many things can be assessed for capital gains. We'll go have a quick look at Investopedia. They got a great little explainer here. Link is on the web page that you'll find in the description. Capital gains is selling price minus purchase price. So what can qualify? You've got stocks, bonds, jewelry, your home, vehicles, collectibles. There's quite a few things that count. You can have your main home removed from that counting if you've lived there for long enough. Certain things don't make it into the capital gains area. But here we have an example of how exactly the capital gains work. So you bought 100 shares for $20. That cost you $2,000. You sold the shares a while later for $50 and you sold them essentially for $5,000. The difference, 5,000 minus your input costs of 2,000, gives you a capital gain of $3,000. In the US, I believe this is what this one is referring to. 15% on that is $450, which means that your profit after your capital gains taxes is $2,550 instead of the full $3,000. Now, depending on the type of trading account you use or the country you're in, this changes. So you need to go and find out what the rules are for your particular country. For me, I live in Canada. So this $3,000, there's another step that gets thrown in. My capital gains might be $3,000, but I only get taxed on 50% of that. So before the gains tax of 15% gets knocked off, I get to chop that $3,000 in half. So therefore, I only get 15% on $1,500, which is $225, which means my profit after tax would be $2,775 instead of the $2,550. I also am using a Tfsa account for some of my my trading and my investments. The Tfsa account in Canada, I don't have to pay any tax at all on any of my capital gains. There is a stipulation that if I try to remove money from my Tfsa account, however, I can max it out at $220,000 a year, I believe, last time I checked. Any more than that I pull, and I have to pay income tax level taxes on it. So every country is different, accounts are different. You need to go and have a look. But the nicest thing to remember is capital gains taxes and capital gains only come into effect once you've sold. If you haven't sold yet, you don't have to worry about anything. Once you've sold, you're going to need to get a financial advisor or an accountant to come in and give you a hand to make sure that you cover all your bases and you have paid all the taxes that you're required to pay. I hope that explains capital gains. Know it, Ollie out.